But let me bring on board Sandip Agarwal, fund manager, Sowilo Investment Managers, joining us this morning to try and give us a perspective with regard to those Infosys numbers. First off, Sandip, how do you read into the numbers? The street seems to be disappointed with a couple of things. One is the fact that EBIT didn't play out as well as the margins didn't play out as well as many expected. And the second piece is with regard to the growth for the coming year. 1.5 to 3.5 seemed a bit soft, seemed a bit underconfident, that big European client actually creating the drag. What's your sense?
Hi, good morning, and thanks for having me on the show. So, as you rightly mentioned, there was some underperformance versus whatever was the street estimate. But let me give you a little more perspective. See, how we should see is that right now, if you see, when a management is preparing the guidance, they go by what they have in hand and also what they have seen in last 3-6 months. And you all know that last 3-6 months have been very, very disrupting for the IT services space, because there was a point of time where every day there were articles coming and saying that 70, 80 or 90 or even 100% of the IT services will not be required. From that, and people were very confident that many of the companies won't issue a guidance, and if they issue a guidance, the guidance number could be very scary. I think from that perspective, things have come a long way. Both from the news perspective, I think now no one is claiming that IT services will be finished. At least people are saying, okay, there will be deflation. And I agree, and we have alluded many times that 20 to 30% effort reduction because of AI spread over 4-5 years means 4-5% annual deflation. And whatever you grow above that is your net growth rate. So if you put this into perspective, then if you take the upper end of the guidance, then it means like 8-9% kind of dollar growth. And if you put the lower end of the guidance, we are talking about 5-6% growth. And remember, after this, things will management will get time, bandwidth, and also things will evolve. So they can try to cover the deflation part. Also remember that when this kind of new disruption happens, client goes into no decision mode for some period of time. And when they start coming back, sometimes huge pent-up demand also comes, like what happened during COVID. Now, I would reiterate that this is not an industry where you should look at double-digit growth and all that. This is an industry where a slower growth for long term, that is 6-7% growth for large companies, and 8-10%, 11% for mid-size, and maybe 12-13% for the small company for next 3 to 5 years, what you should build in, along with some benefits on margin, not only because of currency, but also now when your growth is low, you don't need to maintain a high bench like earlier. Second, all the localization numbers which were required by the developed markets have all been achieved. So incrementally, you don't have any cost pressure other than normal, wage inflation, which is also limited. So I think you have to see from that perspective. In my opinion, the sector should see 13-14% EPS growth for next 2 years at least. And from that perspective, 1.2 peg ratio is quite reasonable. And you can see a 40-50% return, or at the index level, let me put it 30%. So where my worry is only on the ER&D space. Ex of ER&D space, I think IT services, there can be pressure for 1 or 2 days. I can't call that out. But I think broadly, IT services index should do well from here. You should see decent return from here.
Sandeep, I just wanted to get your thoughts on the Infosys numbers. I was looking at the quarterly numbers. The reported growth was minus 1.2%, and the CC growth was minus 1.3%. It does not reflect the kind of tailwind that the forex gains should have brought in. Is IT companies not able to manage the hedge properly because of the kind of volatility that rupee has seen?
No, so you're absolutely right. And you see in the past 20-25 years also, whenever such sharp changes have happened in the currency, that quarter they have not been able to get much benefit, because it is sudden. So you generally hedge in a systematic way, and whenever there is a quick move, then that systematic way doesn't yield the result which they should give. So I think you will see incrementally this change in currency definitely gives a lot of arms in the armor of all these IT services companies to invest more. And I think that is what will happen. So I think, we should not expect magic in margins due to currency in one quarter. It takes sometimes time to flow. And also you have to remember that this depreciation, while, looks very sharp at the end of the quarter, but it has happened over the period of the quarter. So you cannot get all the benefits immediately. And secondly, this was a very disruptive time period. There was so much of noise around AI and the disruption. So a lot of efforts would have gone, a lot of money would have been spent to find new people, new resources. So there are a lot of costs which happens whenever there is a disruption, and slowly you recover that. Third, remember that, December quarter has huge furlough impact, and March quarter has a less number of working day in Feb. So that also has an impact. So I would say a 50 basis point disappointment on growth or 20-30 basis point disappointment on margin should not be taken as a very serious problem. That is the way I would put.
Sandeep, December furlough, understandable. March quarter, less working days, almost the same, right? The number of working days are lower in both from that point of view, so you can compare it. But my question was from a point of view of how companies are not able to use the depreciation tailwind to reinvest into the business. And from that point of view, if you look at the top 5 companies which have come out with the earnings, who was better off in this quarter?
No, I won't say, call out a specific company, because, these are all long-term contracts, and B2B business, the challenge is that you don't know one client, what has happened internally can change, make things look good and bad for others. So I generally don't read that way, but my view is that, you have to look at how the sector is positioned in terms of growth and margins, and what is built in the stock price, and what is the multiple. So from that perspective, I think versus 14-15 months back, and even 1 month, 1.5 months back, today the sector is much more better placed. And I think slowly and also you see the history, barring, whenever there has been a severe crisis like COVID or Lehman, they have not disappointed on guidance. Generally, they have always made their guidance at upper end, and sometimes have beaten guidance, whether it is HCL, whether it is Infosys, all these companies, right? So we have to also take that into account. They don't want to go wrong unnecessarily. So there are a lot of things which will open up as you move to quarter 1, quarter 2, and I think it is a game of patience. There has to be some patience. There is some catapulation happening. There is some uncertainty, and there is a lot of other things, right, in the sector which are happening right now. So I think it is a very decent. So from that perspective, order books are decent, and guidance is also decent from that perspective.
Last piece, Sandeep, out of at least the large cap IT, what are your top picks? I mean, TCS stands out, right? Post all of the other numbers that we've seen, TCS is a real standout on a far larger base. Where are valuations stacked up versus the kind of basically the risk reward? How is it stacked up? Who is best placed?
So, I would love to answer that question if I was an analyst, but now we manage a PMS. It is very tough to give stock specific call. But let me put it this way.
Sure.
Whatever is reasonably priced, and as you already know the names, they are looking good. I am only saying that in IT services, I think a lot of froth is behind. We are at the fag end, or I would say that, we are at maybe at the bottom of the prices of the stock. Where I am little cautious is ER&D, because, there is a lot of multiple froth there. Earnings froth is not there. So let's see. But I would say that, I would reiterate that, these are billion-dollar companies. So you cannot call out, and B2B business. So if it was a B2C business, you can call a trend. But in B2 business, things change so fast. Your top client contributes 5%, 4% sometimes, and they can have a decision delay. They can have any change internally, and because of that, your numbers may look weak. So should not read too much. At sector level, prices are good. Things have corrected, and they are looking much more reasonable. That is the way we should see. And always money is made when your call on sector goes right, rather than on the micro. So I think the sector call is looking good right now.
Okay. Thank you so much for that, Sandeep. We'll leave it at that. Sector looking good for the moment. That seems to be the final take that Sandeep has. But what we're going to do is we're going